Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden deep within corporate filings. And judging by this document, we're about to uncover some very interesting accounting tricks. This SEC filing is a treasure trove of financial data for the Ave Maria mutual funds, covering the period up to June 30, 2025. And believe me, there are some numbers here that make you do a double take. So this report comes from SCHWARTZ Investment Trust, which manages a bunch of funds like Ave Maria Value Fund and others. The main point of this filing is to give us a clear picture of how these funds performed financially over the first half of 2025, a period that saw some significant shifts in the market and within the company itself. Now let's talk numbers, starting with the Ave Maria Value Focused Fund for the 6 months ending June 30, 2025. They reported a total return of 4.36%, which sounds okay, but it actually came in behind the S&P 1500 index, which managed 5.61% now. While some of their top performance is something we'll see across some of these funds, Avi will fight if Ken Feifel at SCHWARTZ and Durov and Fine Bot 614 funds are now. While some of their top performance is something we'll see across some of these funds, but it actually came in behind the S&P 1500 for Fines 36%, which sounds okay, but it actually came in behind the S&P 1500 index, which managed 5.61% now. While some of their top performance is something we'll see across some of these funds. Moving on to the Ave Maria Value Fund, they had a stronger showing for the period with a total return of 5.23%, beating the S&P Midcap 400 index's 0.20%. Their top performers included Wheaton Precious Metals Corporation up 60% and Franco-Nevada Corporation up 40%. However, once again, they had some big names dragging them down. Simply Good Foods Company Inc. fell 19%. And Yeti Holdings Inc. also dropped 18%. It's interesting to see how a couple of these companies are acting as anchors for different funds. Then we have the Ave Maria Growth Fund, which posted a 7.55% total return for the first half of 2025. Their strongest sectors were industrials and real estate, driven by companies like IRCO Corporation, which was up 38%, and SBA Communications Corporation, which contributed to real estate sector gains. But on the flip side, the healthcare sector was a real drag, down 20%, mostly due to IQVI Holdings Inc. Next is the Ave Maria Rising Dividend Fund, with a 3.65% total return for the period. They saw gains in consumer staples thanks to Coca-Cola Europe Pacific Partners PLC. And in communications from Booking Holdings Inc., however, their energy sector took a hit with Diamondback Energy Inc., down 14 points Inc., which was down 9.2%. And the consumer discretionary sector also struggled, negatively impacted by Lowe's Companies Inc., which was down 9.2%. Now let's look globally with the Ave Maria World Equity Fund. This fund actually did quite well with a 16% total return, outperforming the MSCI Voight Index, which returned 10.5%. They saw significant gains from StoneCo Limited up over 100% and Nintendo Company Limited, which soared almost 65%. But even here, some names stumbled. Greg's PLC dropped 22.59%. Jumping to the Ave Maria Growth Focused Fund, they had a 10.26% total return for the first 6 months of 2025. Their best performers were API Group Corporation, up nearly 42%, and Sigma PLC, which jumped over 63%. But like other funds, they had some big detractors. Digital Bridge Group Inc. dropped 13.7%, big detractors. Digital Bridge Group Inc. dropped 13.7%, and Apollo Global Management Inc. was down 13.6%. Finally, we have the Ave Maria Bond Fund, which had a 3.42% total return for the period. They mentioned that their common stock holdings actually hurt their performance against the benchmark, which is a bit unusual for a bond fund. Notable performers included Coca-Cola Europe Pacific Partners PLC, up 22%, but on the other hand, Western Union Company fell 17%. The filing also touches on interest rates and corporate bond spreads widening, which added to the complexity of their performance. Let's zoom in on some of the financial tables to get a clearer picture. When we look at the total return based on a 10,000 investment over the last 10 years, we see quite a bit of variation. For instance, the Ave Maria Value Focused Fund grew to 332 to 356. Fundie shows a general trend across most of these funds where the broader market indices have often outperformed their specific fund strategies. Looking at the average annual returns as of June 30, 2025, we can see the 10-year returns for Ave Maria Value Focused Fund were 12.77% compared to the S&P 500's 13.65%, and for the Ave Maria Value Fund, the 10-year return was 8.80% against the S&P 500's 13 over suggest a consistent performance gap in some cases. Digging into the fund statistics, we see that for the Ave Maria Value Focused Fund, net assets were over $93 million with a total expense ratio of 1.21%. For the Ave Maria Value Fund, net assets were significantly higher at over $500 million with a total expense ratio of 0.91%. The Ave Maria Growth Fund reported over a Maria Growth Fund reported over a Maria Growth Fund reported over a Maria Growth Fund reported over $1 billion in net assets with a total expense ratio of 0.91%. The Ave Maria Growth Fund reported over $1 billion in net assets with a total expense ratio of 0.90%. The Ave Maria Growth Fund reported over $1 billion in net assets with a total expense ratio of 0.91%. The Ave Maria Growth Fund reported over $1 billion in net assets with a total expense ratio. The sector weighting is also quite revealing. For the Ave Maria Value Focused Fund, real estate made up 26.8% of their net assets, while energy was 16.2%. This concentration in real estate could be a risk if that sector faces headwinds. For the Ave Maria Growth Fund, the technology sector was dominant at 48.8%. The Ave Maria Rising Dividend Fund had 28.3% in technology. This heavy reliance on the tech sector can be a double-edged sword, offering high growth but also potential for higher volatility. A key piece of information is that during this period, shareholders approved new advisory agreements due to a change in control of the advisor. This sounds like a behind-the-scenes shuffle, but it's important because any change in control can potentially impact how the funds are managed or whose interests are prioritized. The report states that other than the ownership structure, the operations and personnel remain the same, which is reassuring. This is interesting for the Ave Maria Bond Fund. Their portfolio includes common stocks which contributed to underperformance versus the benchmark. The managers mentioned interest rates and inflation as key concerns, and they are keeping bond maturities short to medium and credit quality high. This conservative approach aims to protect principal but might limit upside in a bull market. Looking at the bond fund's 10-year performance, a $10,000 investment grew to $603 for the $603 for the Ave Maria Bond Fund, compared to $123.7 for the Bloomberg Intermediate US Government Credit Bond Index, and 11980 are performing its benchmarks over the long term, which is quite noteworthy. When we look at the net assets across all these funds, the scale is massive. The Ave Maria Growth Fund alone has over $1 billion in net assets. The Ave Maria Bond Fund is also substantial with over $750 million. The Ave Maria Rising Dividend Fund is just shy of $1 billion. These are not small operations, and their performance impacts a lot of investors. The summary of capital share activity reveals a lot about investor sentiment. For the Ave Maria Growth Fund, they saw a decrease in shares outstanding by nearly 500,000, which means more money was taken out than put. In this contrast with the Ave Maria Bond Fund, which saw a significant net increase of over 5 million shares outstanding, indicating strong investor inflows into that fund. In the schedule of investments for the Ave Maria Value Focused Fund, common stocks represent 89.1% of their investments, and money market funds may suggest a cautious stance, or perhaps waiting for better investment opportunities. For the Ave Maria Value Fund, common stocks make up a huge 97.2% of their investments, with only 3.3% in money market funds. This heavy equity weighting means their performance is closely tied to the stock market. Scroll common stocks, the Ave Maria Growth Fund has an even higher 97.2% in common stocks. This suggests a very aggressive growth strategy with minimal allocation to safer assets like money market funds. Scroll common stocks, the Ave Maria Rising Dividend Fund also has a dominant 97.8% in common stocks. Their strategy here is to focus on companies that consistently grow dividends, which is a more defensive approach within the equity space. The Ave Maria World Equity Fund shows 98.5% in common stocks and only 1.7% in money market funds. This global focus means they are exposed to a wider range of economic and political risks and currency fluctuations. Scroll common stocks for the Ave Maria Growth Focused Fund. It's almost entirely in common stocks at 103% due to some leverage or other assets. This tells us they are all in on growth. The Ave Maria Bond Fund is interesting with 28.1% in US government securities, 48.7% in corporate bonds, and a notable 16.4% in common stocks. This hybrid approach is unusual for a bond fund and explains some of the performance commentary. When we look at the statements of assets and liabilities, we see the sheer scale of these operations. The Ave Maria Growth Fund has over $1 billion in assets and liabilities, as well managed by SCHWARTZ Investment Trust. The management of these vast sums is overseen by George P. Schwartz and Timothy S. Schwartz, who are listed as principal executive and financial officers respectively. The net assets are huge across the board, especially for the Ave Maria Growth Fund, which has over $1.1 billion in net assets. The Ave Maria Value Fund is the next largest with over $500 million in net assets. This scale means their investment decisions have a significant impact on the market. The statements of operations detail where the money comes from and where it goes. For the Ave Maria Value Focused Fund, they had net investment income of $165,242.35, but realized and unrealized gains pushed that to over $1,002,000. But significant unrealized gains helped them report a positive increase in net assets of over $79 million, oval-eyed when only $2,000, but significant unrealized gains helped them report a positive increase in net assets. The Ave Maria Growth Focused Fund reported a net investment loss of over $210,000, which is a concern even though unrealized gains helped them end the period with an increase in net assets. This highlights the risk in aggressive growth strategies. The total return figures are critical for investors. The Ave Maria Bond Fund had a 3.42% return for the 6 months and a 3.86% average annual return over 10 years. These are modest, but for a bond fund aiming for preservation of capital, they might be considered acceptable. The expense ratios are also crucial. For the Ave Maria Bond Fund, it's a very low 0%, which is great for investors. The Ave Maria Growth Fund and Rising Dividend Fund are both at 0.90%, reasonable for growth-focused funds, but the Ave Maria Value Focused Fund is at 1.21%, which is on the higher side. The notes reveal a significant change in control affecting the advisor on May 20, 2025. This ownership shuffle triggered automatic termination and required shareholder approval for new advisory agreements. The advisor's fees remained largely the same, but the change in control itself is a material event usually watched closely by investors. Scroll valuation of investment, significant portion of the notes explain their valuation methods for investments adhering to GAAP and categorizing them into level 1, 2, and 3 based on the observability of inputs. This is standard practice but important for understanding how they determine the fair value of less liquid assets. Looking at the breakdown of assets for the Ave Maria Value Focused Fund, we see 89.1% in common stocks and 10.7% in money market funds. The high percentage in money market funds is something we flagged earlier, suggesting a defensive posture. The report also highlights sector risk for the Ave Maria Value Focused Fund. Their 26.8% allocation to real estate is a notable concentration. And for the Ave Maria Growth Fund, the 48.8% in technology is a significant bet on that sector. Interestingly, the filing details proxy voting results from a shareholder meeting where a new advisory agreement was approved with overwhelming support. This is good news for the stability of the funds and the management team. Initial analysis, okay, so let's cut through the jargon here, What's the story of these Ave Maria funds as of June 2025? First off, the performance across the equity funds is mixed, with some significantly lagging behind market benchmarks, like the S&P 500, especially in longer term returns. The bond fund is a bit of an anomaly with its equity holdings, but seems to have outperformed its bond benchmarks over 10 years, which is a positive sign. A major development is the change in control of the advisor, which led to new advisory agreements. While the terms are similar, this kind of event can sometimes signal future changes or potential instability. However, the report suggests operations and personnel remain consistent. The concentration in the technology sector for several funds is a clear strength if tech continues to perform, but also a notable risk. If tech falters, these funds could see larger drops. The bond fund's conservative approach in a tricky interest rate environment is understandable, but might not capture the full upside of market upturns. Overall, the funds manage enormous amounts of money, but investors need to carefully consider the expense ratios and benchmark performance. The higher expense ratios in some funds, especially when performance lag, suggests a need for closer scrutiny. The fact that they're adhering to specific moral screening criteria adds another layer of complexity and potential performance impact. What's your take on these numbers and what they signal for the future of Ave Maria funds? Let us know in the comments below. If you found this deep dive valuable, give this video a big thumbs up and subscribe to Corporate Decoder for more insights like this. And don't forget to join our Discord community linked in the description, where we break down more financial mysteries. Thanks for watching. See you in the next one. Initial analysis.